Today's podcast is brought to you by Dalupa. Dalupa's database of over 2,500 models contains the most KPIs for each company, along with non-GAAP adjustments and guidance specific to the business and the quarter. Clients use Dalupa's existing data to construct their own models faster and ramp up on new names more readily. Coupled with Dalupa's plugin, which automatically updates numbers and formatting within your model, you'll never need to input numbers manually again. All of Dalupa's data points are contextual, audible, and accurate. Their AI algorithms allow them to collect the most data on their companies at the greatest speed and build out their model database at a rapid pace, while their final layer of human analysts ensures total accuracy of their models. You can even update KPIs for multiple different companies in an industry model that allows you a bird's eye view for better idea generation. Save time with Dalupa to do more value-added work. No more data errors, no more Excel monkeying, just the fundamentals, all at your fingertips. All right, hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow it, rate it, review it, wherever you're listening, subscribing, whatever. With me today, I'm happy to have on for the second time, my friend, PJ Kurzweil. PJ, how's it going?
It's going well. Thanks for having me on again.
Hey, thanks for coming back on and thanks for doing it so quick. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone that nothing on this podcast is investing advice. Please do your own research, consult a financial advisor, all that type of stuff. But we're going to talk about a stock idea here today, but it's not investing advice. And then the second way I started your podcast is a pitch for you, my guest. People can go listen to your first podcast to hear the original pitch. But look, you're a sharp guy. I know the first podcast got really nice reviews. I had people coming out the woodwork be like, BC trading for 7 times earnings and earnings are going to grow. Like, this is a pretty interesting story with share buybacks. And we've got another one of those today. So that all out the way, let me just pitch it over to you. The company we're going to talk about is Spectrum Brands. The ticker is SPB. And I'll turn it over to you. What is SPB and why are they so interesting?
Thanks, Andrew. So as you said, ticker SPB, $3.2 billion market cap company. Just giving you a little history here. The company was founded in the early 1900s as a small battery company. It IPO'd as Rayovac in 1997, which would tell you that, it still maintained its battery heritage until a few years ago. The company did some subsequent acquisitions in the early 2000s in the home and garden space, in the global pet care space, and in the home and personal care space before rebranding in 2005 to be Spectrum Brands. The playbook here historically has been to acquire consumer staples and durable brands, mostly US focused, except for the home and personal care is a little bit more of a global business. But in any case, they want to leverage their channel relationships to boost distribution across geographies or retail channels. And obviously leverage a centralized infrastructure for back office and marketing and things as such. The company did pick up some leverage, did run into some trouble in the global financial crisis, filing for bankruptcy in Feb of 2009 when they missed a interest payment. There was a debt for equity swap, which is how HRG got involved, which David Moore was an analyst for at the time.
I remember those days. You might dive into the history. I remember Jeffries had a stake, HRG. Yep. I remember all the drama.
Yep. So moving, those are interesting details over time. But thinking about the business today and why we're talking about it, Spectrum is undergoing a significant transformation, moving from what we'd say a bloated platform company to a much more focused home, garden, and pet business. As I'm sure we'll get into a lot of discussion on, they are selling their hardware and home improvement business to Assa Abloy, ticker ASSAB, which will bring them to a net cash position and, per a lot of management's comments, allow them to buy back a lot of stock. They're also in the process of separating their least desirable business, their home and personal care business, a lot of which is contract manufactured out of China. Bottom line, lots of hard catalysts here, but also a meaningful improvement in the business and financial profile of the company when you think about it on a go-forward basis.
Perfect. I want to dive into a bunch of different things there, and I've already sent you my list of questions. People can see it in the show notes that I posted before we get started. But I guess my first question is always, look, we're going to go into a lot of stuff, but this is Spectrum Brands. It's a company that's been around for a while. As we mentioned, look, Jeffries had a stake in it. HRG had a stake in it. It's a lot of personal brands. People know this company. So my first question to you is, what are you and the company, because the company's been very clear they want to buy back stock. What are you guys seeing that the market is kind of missing and thinking this stock is cheap, this stock is an alpha opportunity?
Yeah, no, that's always a question I try to answer when we first get to looking at an opportunity. I think there are a few different pieces. I think bigger picture, I think the home and garden and global pet business do have some very interesting tailwinds that don't just make it a COVID winner, but maybe a COVID accelerant or an accelerant because of COVID. And we can talk about those trends in that business. People have some questions about the HHI business, hardware and home improvement business, and whether it'll get sold. I think we can certainly discuss that. I don't have an excellent antitrust argument, but there's certain pieces we can point to feel more confident about that. But that's a huge game changer from the balance sheet, especially with the business currently having it in discontinued ops, but not giving it credit for in the EV. I think people probably don't give it as much credit for getting rid of HPC, home and personal care. I think that will be margin accretive. It will be growth accretive. I think this business will be, a smaller business, but a more focused business that will get better coverage on the buy side and sell side. You're not going to have to straddle building products and consumer products. I do think there's a good chance this business will go after central garden and pet, which is more of a down the line feature. And I think investors probably underrate this company's desire to buy back stock.
Yep. No, that all makes total sense to me. I guess the first place we should start is the HHI sale, because my Bloomberg is refusing to update currently, but if I've got my numbers right, at about $80 per share, this is a little over 3 billion market cap, somewhere between 3 and 3.5 billion. It's got about 3 to 3.5 billion of debt, and they're selling HHI for 3.5 billion. So we're talking about half, a little more than half of the enterprise value. Sorry, they're selling HHI for more than 3.5 billion, but 3.5 billion is the net after tax, after fees and everything. So we'll just say 3.5 billion. So this is more than 50% of the enterprise value. Obviously, that's a huge, meaningful number. So I just want to start there. HHI, what is it? What's the multiple they're selling it for? And why is the market worried that this deal might not happen?
Great. So HHI, Hardware and Home Improvement, was a business that was acquired from Stanley Black & Decker back in 2012 for about 7.4 times EBITDA. 69 roughly % of the business is in the lockstep.
Just real quick, because I think it is important when people think about this management team and the company's history. You said 7.9 times EBITDA, but could you also put a dollar figure on what they acquired it for?
1.4 billion for 7.4 times EBITDA on a trailing basis back in 2012. So 1.4 billion. That's and so roughly high 60% of the business is lockset, which is really what Assa Abloy, the acquirer, is interested in. The rest is faucets, their Pfister's brand, or you call it plumbing rather, and their hardware business, which is, door hinges, things like that. So the Lockset business is really sold under the Kwikset brand. It's also sold under the Baldwin and Weiser brands. And they're a really strong player in the mid-tier residential home market in terms of 75% exposed to repair and remodel, 25% exposed to new construction. They primarily sell through the DIY channel. We're about 40% DIY, Home Depot and Lowe's, and the rest they sell through builders. And really, the goal there is that people will continue to need locks over time, albeit it's a durable good. But there's a real opportunity to move towards electromechanical locks, smart locks, locks that can unlock using different verification features. And also, they even have a business that can be rekeyed on its own. One of the Kwikset businesses can rekey a key in 15 minutes. Go ahead.
No, I was just going to say, look, I remember looking at this in 2018 or 2019 and being like, oh, that's silly. But then if you ever go to an Airbnb and they've got those electronic locks, so you're not like searching for the key in the dark of night or something, like that is what this business does, right? These electronic locks, all sorts of different locks. And once you experience, like, instead of having to take out your key and do it, once you experience hey, just tap a couple buttons and get in, like, it really is a difference. And, I don't know, there is a little scale here. I mean, I don't think it's the greatest business in the history of the world, but you can start talking to yourself, hey, at the right multiple, this is a business that should grow, that should at least GDP growth. There's probably a replacement cycle. Anyway, I'm ranting a little bit. Just wanted to add that because I do remember looking at that and thinking that.
Yeah, it's a high teens margin business. EBITDA was mostly within the 250 to 260 range after it bumped when they bought it. Last year was a blowout year, whether it's stimulus or people staying at home, building home offices, whatever it might be. So Assa Abloy, they're a behemoth listed on the, Swedish stock exchange. They are 75% commercial, 25% residential focus. I think they own the HID brand. They do a lot of different things, but they've always wanted to enter into the US residential market. But Schlage, I guess you pronounce it that way, and Kwikset, which is Allegion and Spectrum, really have a stranglehold there. And Assa Abloy just doesn't have the connections through the home builder channel or through the DIY channel, which is why they wanted to acquire it. They are acquiring it at 14 times EBITDA back in September 8th, 2021. It was announced. They believe they can synergize it down to 10 times EBITDA, which would be, reasonable compared to their 12x multiple. It's the biggest deal they've ever done, but this is, like a $22 billion market cap company, I think, when you look at it in US terms. And, this does not have a huge deleterious impact on their balance sheet.
Yeah. And then, so I think there's a regulatory angle, and then there's just a price angle here, right? Like, this is not, to use a topical example, this buyer is not Elon Musk. Oh, like, we paid 14 last year and now it's worth 8. We want to get the heck out of here. We'll do. But there is a real regulatory angle here. So why don't we talk regulatory concerns? And then I think that'll bleed into a discussion around multiple, because I do think people say, oh, sale announced in September or October, multiples are a lot lower now. Like, what's kind of the downside? But let's start with regulatory.
Great. So unfortunately, we don't have a ton of information. I am not a lawyer. I did consult a lawyer for certain general matters in terms of the process, but I didn't find an analog in terms of a similar type case, nor that, if your bet here is purely, will the case be denied on antitrust basis? Maybe you want to wait to see. I'm totally open to that in the thesis. But in any case, the timeline that we kind of map out is that they announced the merger early September. The first request is basically satisfied when the companies submit documentation to the regulators. Again, we don't know in the US if it's the DOJ or the FTC. And this business is predominantly US. So we'll just focus on the US regulatory situation. The HSR period obviously expires after 30 days. The companies still indicate the merger is not closed, so we know that there was a second request. We understand that the DOJ and or FTC have been extremely thorough in how they analyze these cases, so they probably gave them a lot of things to look at in terms of giving them additional documentation. Companies can take anywhere from 4 to 6 months, maybe less, maybe more, to satisfy the second request. I wouldn't say the burden is on the buyer. Both sides have to contribute materials, but obviously Assa Abloy is pushing this along. So that second request would have been satisfied by our timeline in March or April. At that juncture, the regulators may or may not have entered into a timing agreement, which basically gives them more than 30 days to kind of review everything. And so that kind of puts us in the July-August timeframe. Okay, great. And the merger drop dead date is December 8th, 2022. So in terms of antitrust, most of what I'll share has been discussed by the company, but basically Assa Abloy does not have a real material presence in the US residential lock set market. They do have the MTech brand and a Yale brand, but definitely not in the mechanical lock business. That's not a big part of their business. Now, in the US smart lock business, they do have the Yale brand and the August brand, and HHI has the Kwikset brand. And if you kind of sum those up based on a consultant report that Assa Abloy provided in a press release, I believe it's somewhere in the mid-30s in terms of market concentration for consumer global share in the smart lock business. So the smart lock business is probably where it gets interesting. You know, in the merger agreement, you know, maybe it was poor drafting, but they agreed to do any and all remedies for antitrust subject to certain carve-outs that were obviously not disclosed to us. So would they be willing to sell the August business? Would they be willing to sell the Yale business? Will U.S. Regulatory body require them to divest in any case? Again, Allegion also plays in the smart lock business. So those are the general variables. Go ahead.
To me, just like 30%, you say they'd have mid-30s market share at smart locks. And like mid-30s is generally when having been exposed to antitrust. Mid-30s, actually anything higher than 25% is when your ear starts to perk up like, oh, maybe this is a concern. But at the same time, like it's smart locks, you know, like it's tough for me to argue that there's tons of lock-in or that it wouldn't be easy to switch to any of the other 65% if these guys like it just does.
I'm sorry, you cut out for a second. Go ahead.
Oh, no, it's just hard for me to imagine like smart locks, like there's not competition, that it'd be a very narrow definition of the market to say, oh, these guys have 35% of the market share. So all of a sudden your smart locks are going to be costing like $1,000 per door. You can go with the old locks. There's 65% of it strikes me as a little bit of a far-fetched that this is a real antitrust issue. Right.
So just to be clear, Assa is about 20. And then I think Kwikset is, I don't know, 14, 15, 12. So that's how you get to 32. Yeah, look, Assa Abloy this business is about technology and innovation. Spectrum Brands is just probably not the player to really innovate the way Assa Abloy can. So you're basically replacing, you know, I guess in the smart lock business, you should at the end of the day get better products for the consumer.
So let's talk about, I think that covers HSR nicely. So let's talk about valuation, right? Because they're selling this for 4.1, 4.2 or something. Net after taxes will be 3.5 to SPB. And I think the big downside that anyone who looks at this for 1 second is going to say, hey, Andrew, you just told me how their proceeds from HHI are going to be more than 50% of the EV. If this deal falls through, then all of a sudden, like the EV, you know, it's not. And they agreed to sell it in September at 14 times EBITDA. Multiples are way down there. So how do you think through the downside and what HHI would be worth if this was blocked for some reason?
Okay. Well, first, the break fee of $350 million, it's about 8% of proceeds, or 8% rather of the purchase price compared to usually 4 to 6% that you would see. And that's triggered even if the deal falls apart because of antitrust remedy requirements that are too onerous or subject to the carve-outs. So that should give you some confidence that Assa Abloy feels as though they can close the deal. Look, I think in Assa Abloy's merger call, which everyone should read, I mean, Spectrum had a call, Assa Abloy had a call. They do briefly highlight that this was a 2-round process and that it was a competitive process. And if you take a step back, you think about it, this is a business, Kwikset has like 40% market share. It is concentrated on the customer side. So you can't just be a small guy and just pop up here. So there's definitely some scarcity value here. I would think there were other strategics that may have sniffed at it, whether it's Fortune Brands or other companies, maybe a Masco. And I think there would be private equity interest. And I think the company, you know, through anecdotal conversations, I think the company has acknowledged at some point that this has been a business that has gotten inbound interest over the years. So in terms of how do you value that, there are not a lot of precedent transactions for us to look at of scale. Allegion trades at roughly 13 times EBITDA. And I think I argue in the write-up, it's a better business. But if you give account to some control premium, you can probably shake out around 10.5 times EBITDA, and that's not, you know, that's not killing anybody. Granted, it's on a higher, it's on a pretty good EBITDA base of 307, but that's, you know, roughly a 25% haircut And that to me, finger in the air kind of makes sense.
So if I'm doing the math right in my head, right, like HHI, I think I've got them at called 300 million of EBITDA. Is that right? About 300 million. And so they're selling it for 14 times or so. You're saying, hey, in a downside scenario where this breaks, it's 10 times. So that would be net $1.2 billion loss, but that would be offset by two things. A, you get the 350 million break fee, and B, you're burning about $600 million of proceeds in terms of just kind of taxes, transaction expenses, everything. Obviously, some of those stick if the deal falls through. But, you know, if you're talking the difference between keeping this business and valuing it at 10 times and selling it at 14 times, if you're talking the difference is, call it 700 million, yeah, that's not great. We'd obviously rather sell it, but it's obviously not the end of the world, right? It's not, I hate to bring it back to Twitter, but it's not Twitter where you agreed to sell for 54, and given what the market's done since then, it's probably worth 20 or 25 on the open market. So there's this mammoth difference.
Yeah, I would say a couple other things. Look, if they have to do another deal, they're going to be more deal fees, right? But I think that's probably offset slightly by the fact that their NOL utilization, they say they're going to burn them all up with this deal. It's possible that with a smaller deal, they'd be maybe more fully covered on a tax perspective. But yeah, and there's also the question as to whether Spectrum Brands would even sell it for 10.5 times. But I think they've made the case that this business is not a platform for scaling up. It's a durable business. It's a good business, but it's just not fitting into the rest of their platform. And so I think 10.5 times might be, you know, the high end of the range of people would give it if it were still part of the company as a sum of parts. But I think for a controlled premia, scarcity value, I think it makes some sense.
Perfect. All right. So that covers, you know, I think the issue that anyone who studies this is going to be the first scary thing. And like the answer is, hey, hopefully the sale goes through, but if it doesn't go through, it might not be that scary. So let's talk about the other pieces of SPB. So like the two big pieces here, there's HPC, which they're looking to sell, their consumer brands. But then the two pieces that are going to really drive this going forward are the pets and the gardening side. So let's just talk about them. You know, how big are these? What products do they sell? Why are these nice businesses?
Yeah, and I just want to say one more thing about HHI. I think you all should listen to Andrew's podcast from last week he hosted with Jeremy.
Oh,
there are some people who just think that you can walk away from a merger. Maybe Elon Musk thinks he can do that.
Elon Musk certainly thinks that, yeah.
You know, I don't think there are any surprises in the HHI business where someone's going to say after they do a ton more diligence that there's a material adverse effect or change. So anyone who kind of thinks that this deal is just not going to happen because, you know, Assa Abloy has buyer's remorse, A, it's a strategic asset to Assa Abloy, but B, it generally doesn't work that way. Even as a non-lawyer, I think I can say that with some degree of confidence. Yeah,
look, buyer's remorse, I'm sure there have been plenty of people in history who've signed deals and been like, oh, this is awful. But if you can just get away from deals without anything other than, hey, I've got some buyer's remorse, I think I overpaid. Like one of my arguments for Twitter is Delaware law stops working if every contract you sign and 2 weeks later you say, I kind of wish I hadn't signed that. I'm just going to walk away now. Like, and as you said, this is a real buyer. There are real synergies here. They're trying to get through. There's a very tight merger contract, which is generally what happens after you have, as you said, a 2-round process. You generally get the seller gets a very seller-friendly contract because other people are willing to pay it. So yeah, 100% agree.
All right, so we can cover HPC and then we can talk about really what I consider the RemainCo businesses.
Great.
So home and personal care, it really began with Remington in the early 2000s, which I think is somewhere between $400 and $500 million of sales. That's sort of a hair care product, personal grooming brand, not top tier, but it plays globally. They then did a Russell Hobbs merger. They acquired that for roughly $675 million. It was a stock for stock merger. That Russell Hobbs is better known in the UK, but they got the licensing rights for Black & Decker to make toasters and things like that. They got the George Foreman brand is a pretty big brand. So
I remember that. Yeah, I forgot that they owned the George Foreman brand.
exactly.
Is that still doing well? Like I remember in the 90s, right? Everybody had the George Foreman and there were the ads and you'd lose weight because it would like grill out the grease and everything. Is that still around? I'm not sure how that's held up in kind of the digital age.
Well, I mean, look, people still need to cook food. It's not like their avatar is going to eat food for them. So I didn't mean that snidely. I think they're actually innovating, making a smokeless grill. I know my girlfriend cooks food in her apartment, and the smoke alarm always goes off, and I have to turn it off. But hopefully, that's an interesting piece of innovation.
PJ is a tall guy, so he can reach up and press that New York City smoke alarm when it's all the way up there.
Exactly. So the business today is, I think it's roughly 60-40 kitchenware and home sort of personal care. Look, the business is predominantly contract manufactured out of China. That's what's kind of made it a little challenging for them. There's been the tariffs in 2019. There's inflation. There's particularly freight inflation. And it's generally a low single, high single digits, low double digits business. I comment in the write-up that it's really gone from 15% margins to like 8% margins. There should be a bounce back in the second half of the year as they get price. These guys, I think 32% or so is sold through Walmart and Amazon, but there's private label competition here. I mean, these gizmos have 6 to 9 years of average life, and they're not the most sophisticated devices. So they recently did the TriStar acquisition. That's another $325 acquisition price. Basically, TriStar has like, I don't know if it's Power XL, Emerald Lagasse, another throwback, his equipment, and I think Copper Technology. So, but they also have a direct-to-consumer studio. They can sell stuff on TV, which is another channel. But critically, this gets this business to around a $1.7 billion revenue business and a roughly $140 million EBITDA run rate, something that can stand alone. So that's the overview of HPC. They haven't scaled it beyond the Russell Hobbs deal and just the very recent TriStar deal. There was a rumor that there was inbound interest actually in 2018 that they were going to sell it. They did a very smart thing and gave guidance for that sale, the timing and the proceeds, which wound up falling through, whether it was tariffs or just them not getting the price they wanted. There was a rumor last year that CBC was going to try to merge it with Conair in a JV structure, which is kind of why you hear JV rumors today. Mm-hmm. And ultimately, it's the lowest quality business, in my view, and I think in the view of many people. And so just having the scale to divest it, I don't think you can IPO it just given the markets, but given the opportunity to sell it or spin it, I think those are really the paths forward for that business.
That makes total sense. And then, so, in your write-up, you've got, hey, this can sell for about 10 times EBITDA, which, to me, most consumer brands, the 10 times is about right. But you do start running in, and I think we'll talk about this with the pets and home and garden in a second, but you do start looking and you say, okay, well, the whole company's trading for 9 times EBITDA. This is their worst segment, like 10 times EBITDA. Yes, I get it. But it does start to stretch. And I would say, like earnings have declined. I'm just looking at their year over year number, like from 76 million in the first half of 2021 to 38 million in the first half of 2022. We'll talk inflation, all this in a second, but I just look at all that and say, PJ thinks they can get $1 billion for this. That'd be a pretty aggressive multiple on trailing numbers, just given how much earnings declined in the first half. And it doesn't seem like that great a business. People have known it's been for sale for years. Like, is that really reasonable?
So a few things. Maybe first on the earnings power. Inflation is a big factor. Definitely ocean freight. Those have spiked and kind of persisted. This is also a business that is impacted by resins, metals. So I really think, and in the Barclays conference right after the deal, management admitted that HHI and HPC are really most exposed to inflationary forces. The way I tried to think about it is that the business is under earning, just given tariffs, inflation as such. I don't assume tariffs reverse, but the company has said a few times that really this business should be a low double digits business. We often know that there's a buyers and sellers multiple. There'll be what the seller is excited to sell it at and what the buyer's saying it's getting at. And so really, I tried to reverse engineer that. I put the sort of the details in the write-up, but I think in the bear case, they buy it for a 5.5 times buyer's multiple. And I think it's 6.5 times the buyer's multiple. And then I think maybe an 8.5 times buyer's multiple. So I think that's important to highlight. The base case is 7.5 times buyer's multiple, but really it's the delta in the margins. And, anecdotally, it sounds like there could be a lot of cost synergies from someone else picking it up. So that's kind of the way I've thought about the sale there.
No, this is consumer brands tend to be some of the highest cost synergies because, you own, as you mentioned, Conair, you own the Conair brands, you go and buy the George Foreman brands. Like you can basically fire everyone in the finance departments. All of a sudden, like you had one relationship manager at both sides who was managing the Walmart relationship. Guess what? You can merge that. You can pack everything in the same boxes, merge distribution centers to send it to Walmart. Like you've just got so much duplicative costs because you guys are doing the exact same thing. It does tend to be one of the highest. Let me ask on inflation. I was going to ask this later, but I might as well ask it now. HHI, HPC have been two of the hardest hit by inflation. And the company's called out multiple times. Like I've got a quote out there that says, hey, our continuing operations are going to do like 300 or 400 million of EBITDA this year. That's after we had $400 million in cost headwinds from inflation in the first half of the year, right? So my question on inflation, we've talked about how it's hit the company in the past, but the company has said, hey, we've taken price increases, and by Q4 especially, those price increases will have flown through and will be offsetting a lot of inflation. And I do wonder, like, I've wondered this for a lot of business, price increases tend to be kind of sticky. And if we got into a situation where their fiscal 2023 or just calendar year 2023, whatever you want to call it, ocean freight has come way down. Metals have come back to kind of where they were a year ago. Could you be in a scenario where all of a sudden these guys are like printing margins way above what they normally do just because these inflation things that kind of spiked have come back and they already took the price and they kind of look and say, hey, we don't need to give all that up instantly. It takes a while. Is that a possibility or am I kind of dreaming?
I think conceptually it makes sense. I'll say I haven't been a buyer for one of the customers in terms of the retailers to really be able to speak to the mechanics there, but that we see that in commodities and other businesses. Look, admittedly, Walmart announced 2 months ago or a little more than a month ago that they wish year over year inventory rose 15 billion, and they kind of wish they didn't buy 20% of that or 3 billion. So, and that's across all products. So, if inflation comes down, but the consumer is weaker, will the customers that Spectrum faces want to get charged lower prices? It's, I think there is some understanding between the retailer and the consumer product company as far as how temporary or how permanent some of these price increases should be. So I hear you. I think it makes good sense, but I can't speak confidently that there won't be some reversion as well.
That actually dives nicely. So I think that covers personal products. Let's go to pets and home and garden, and we'll talk about each of the individual segments. But your discussion on Walmart, made me think of the high level bear case for these. It's, hey, Walmart and Target, if I remember correctly, they said the right inventory is still moving really quickly, right? Like Target had this thing where they said, hey, our luggage is just flying off the shelves because people want to travel, people want to go have experiences. What we're having issues moving is a lot of the home stuff that we stocked up in 2021, and people already bought that. They don't need any more and they want to go experience. So my question on home and garden and pets would be, both seem to have great tailwinds, but especially home and garden, because Penny's sitting behind me. I was checking my thing to see Penny, my dog's behind me. Like, once you buy a pet, like that's a unit pet, you're not going to get rid of that. You're going to keep buying food, products, whatever for it. But home and garden, I do wonder, this was a massive COVID beneficiary. And if we're looking at 2021 earnings, are we kind of missing the forest for the trees? Because 2023, maybe people don't care as much as their garden. Maybe people are traveling. They're not as much at home care. Was this too much of a COVID beneficiary pull forward? And I do think back to, you mentioned in the pod, in your write-up, Scott's Miracle Grow, right? Which has seen their stock come down a lot. Part of that is marijuana driven. There's other stuff, but part of it is people were buying fertilizer like crazy a year ago, and maybe they're not buying quite so much this year.
Yeah, I saw your question when you sent me just before the interview. I pulled up a Scott's Miracle Grow presentation, and actually the one area where they have seen increase in point of sale has been in the control space, which is the weed killer. So, and obviously Spectrum competes there with their Spectracide business. So a lot to unpack with Home and Garden. It's a very seasonal business, very weather dependent business. Look, Central Garden and Pet said recently that it was, I don't know if it was a horrific May or just a horrific weather start to this quarter. I think, but you know, a good week in May can more than make up for it, right? It's lawn season. It's time, you know, it's warmer out. There are more insects. You know, there's more weeds, etc. So I think 20 and 21 probably had some really good weather, and I think 21 saw some restocking. So I think 22 is up on a tough comp. In terms of the future of gardening, I mean, look, I think it's a hobby. It's outdoor living. I think some people view those as positive secular trends. There's movement from blue to red states, you know, going from cooler environments to warmer environments. And in fairness to Spectrum, they're actually focused on a pretty narrow area, really focusing on pest control. You know, 39% is weed control, and then a smaller amount in cleaning and personal repellents. So I find that is probably a little less subject to sort of a large bounce because people want to grow new things. But I think there are some secular trends that probably keep this, you know, growing better than the 1 to 2%. You know, I mentioned Scott's Miracle Grow took up their guidance long-term to 2 to 4%. Obviously, they've had some issues this year, to what you were saying. So that's kind of how I think about it.
No, that's great. I did have one question. You mentioned this earlier, and it's in your write-up, that I think it was millennials are actually a little more likely than boomers to, I'll just say, invest in their lawn, right? Like they do a little bit more lawn care. It's not like millennials are 7x more likely or something, right? But it is, they are more likely. And that would be a tailwind, just as you think about boomers continuing to age up, millennials continuing to buy. And look, maybe it's my New York centric lifestyle, or maybe it's just, but I was a little surprised by that, just because, you know, I feel like, again, maybe I'm interpreting the story too much. Like the American dream was such a thing in the 60s and 70s. And I feel like now it's a lot more people rent, or maybe they're willing to move a little more so they don't kind of put that same TLC in their yard. So do you think that there's real legs to the millennials are more likely to invest into their kind of home, and that's a long-term tailwind for these guys, the Scott's Miracle Grow 2 to 4%, or is maybe that there's a misinterpretation of the data there?
Well, I think there's some good data that says that millennial home ownership has grown. You know, home ownership, I would think, predominantly is single-family housing. There is the notion of deurbanization to a small extent. You know, I don't know if it's going to offset the longer-term trend of urbanization, but that has both positive implications for global pet. You know, people who rent in apartments may not be able to have a pet, but you can have one when you have a home. And likewise, when you have a home, you have some sort of lawn that you want to take care of. Another piece of data I didn't mention, but came from Central Garden and Pet, was there were actually 18 million new gardeners in 2020. So that's that. I mean, I think gardening is largely viewed as an older person sport, so to say.
That's kind of what I was driving at. Yeah.
Yes, I think it's been encouraging that millennials have kind of stepped up and taken more care of their gardens. I think, again, it is a concept of outdoor living, which I think has become a bigger factor in COVID. I think people get to spend more time at home because of work from home. And I think people want to be outside to interact with friends and do things. And so I think it is a really fair, I think between the global pet and home and garden, I think the secular story is probably a little stronger for global pet. You know, home and garden will also benefit long-term from global warming, in my view, just given the increased number of insects you'll have over time. And, more rain and during warmer weather would help with weed control. But all that was mentioned in the write-up. But that's more or less how I think about it.
Perfect. Let's talk global pet, and I want to be cognizant of time, but there are some good brands here, right? Like oh no, they only have Europe Imes, if I remember correctly, but Nature's Miracle, which I was laughing, the front page of their investor website is Nature Miracle stain and odor remover for pets. Is somebody spraying it? And I am certainly familiar with that product from when Penny was a puppy, but there are good brands in here. Let's just talk about, when I say global pet, right? Like the things that pop to mind would be like something like Purina. There are good brands here, but they don't have like the Purina or the Blue Buffalo brand or stuff like the really top brands. So can you talk to me just a little bit about how good their brands are? What are the competitive moats in global pet care?
Yeah, I would say first, competitive moats. They aren't as robust as they are in home and garden. We didn't really talk, but in home and garden, there's the EPA, and that kind of helps with structurally higher margins. And there are usually only a few key players in the categories: SC Johnson, lesser extent Central Garden and Pet. Look, dog food is a competitive business, and it's typically dominated by bigger players like General Mills or Buffalo Blue, as you said. So I think that's probably why they don't play in that space. And to the degree to which they played in that space with the European transaction, it just didn't work out well for them. So really, they are focused on the dog treat space, Dreambone, a few others that I'll pull up in a second. They play in, like you said, the dog or pet cleanup space with Nature's Miracle, which is a real brand. And they play in Furminator, which is dog grooming. And so they're 70% companion pet, which means dog and cat, 30% fish. They also own the Tetra brand, which is a pretty dominant business in the fish business, as well as in the fish tank business. So there is a real private label place in global pet. I think, interestingly, Central Garden and Pet said that during the crisis, people actually went more for brands than for private label. I don't know if it's just trusting that the manufacturing process was better and pet wouldn't get COVID or whatever it might be.
That's interesting.
Yeah. So that was kind of an interesting data point. And look, private label is a real player, and Central Garden and Pet does make private label, but I do think people want to give their dogs treats. These are all really consumable things, and there's the humanization of pets. There's the proliferation of more pets. I think someone said 57% of existing pet owners actually got a second pet, which might be hard in your apartment, Andrew, but people have done that.
It's not the apartment that's the holdback. It's the wife that's the holdback for the second pet. But I do
exactly. So lower barriers to entry, but still high teen margins. I think Spectrum as a whole likes to play in certain niches where they have a good position. I will note General Mills bought Tyson's pet treat business, which it was a sizable but not massive business. And SPB said it was rumored to have gone in the high teens.
Perfect. Let me so home. Actually, why don't we just cover home and gardens at competitive edge as well? So like we just did pets, and I'm with you. Like once you get a dog, there is some barrier to entry here. Once you get a dog and you start giving it treats, like they do play a lot in treats, the nice thing is that's really renewable. And, you tend to want to give your dog the same thing, because if you've ever switched kibbles brands and all of a sudden your dog has diarrhea or something, like that is awful. So, these tend to be very, very sticky products, similar to if you chew gum, you tend to stick with the same thing. Let's go over to home and garden. You mentioned briefly, but I think this is kind of the crown jewel business. Nice long-term tailwinds, nice regulatory moat. Why don't we just cover that real quick?
Yeah, there's a 2-year EPA registration process. These are chemicals that are in these products, whether it's on your lawn or for killing insects inside your house or other pests. So really, that's the barrier to entry. It's not easy. It takes a while, and it's not that easy to get into. So I haven't seen a huge amount of private label in that space. There may be some, but I think really, it's generally dominated by really a few select players. So I haven't really seen precedent transactions in that space. I don't mention any in my write-up, but I did see Green Garden was acquired by Central Garden and Pet. That's more seeds on the herb side and vegetable and flower. Central Garden and Pet didn't disclose that multiple for the $532 million transaction, but they said it was in the teens. So I think, insect repellent business, pest control, I think there would be an appeal from a cash flow business. Doesn't require a lot of CapEx, but it's really the EPA that probably keeps people, out of that business.
Makes total sense. Makes total sense. So let's talk valuation real quick. So in your write-up, you say, hey, look, I think the stock is trading for maybe 7 times, let's call it 2023 EBITDA, 10 times 2023 unlevered cash flow, which are really attractive multiples, right? Like we've talked about how they're selling HHI, but I would think GPC would be worth a probably 12 plus multiple on if you put it for sale. We talked about how you thought HPC is worth 10. We talked about, a home and garden would probably worth 12, 14. It depends on the environment, everything, but the whole company, bottom line, whole company trading for what you think is 7 times forward. And we just talked about how the sum of the parts are worth almost double that EBITDA multiple, right? So, but my 2 questions there are like 2023 earnings are going to be a lot higher than trailing earnings because trailing earnings have been impacted by inflation. So how do you see the path to getting there? And then B, like, why that multiple discrepancy? Like what kind of closes it? Why do you think you're right and the market's wrong? I know that's a lot to toss out to you in one question.
No. Look, I think in the write-up, it's not, we're talking 3 different scenarios where the multiples vary and the financials vary. So I'm happy to unpack it here. So basically, first to kind of restate it, the 7 times EBITDA for a RemainCo is assuming that HHI sells for 10.5.
Yep.
Times EBITDA. If it sells for 3.5 billion, RemainCo is like sub 6 times EBITDA. Now, the point of comparison between the EBITDA and the unlevered free cash, the unlevered free cash refers to 2024, where we see less restructuring expenses, which really has been part of the Achilles heel of Spectrum. I see them stepping down next year to 20 million, although it really depends on whether the transaction closes before their fiscal year, which begins 9/30 or 10/1 rather. But really, you also see a huge per share jump because of all the buybacks, which doesn't really impact the EV to EBITDA. So I used unlevered free cash because this business is going to be effectively net cash, and I think you want to give it credit for that. And so look at some of the competitors. I looked at Central Garden and Pet, and they trade at like 20 times EV to unlevered free cash. It's a little bit of a quirky type multiple, so I only really mentioned it in the one pager, but that is one way to kind of see the cash flow relative to how big the company is.
Unrelated question to any of that, and I actually do want to come back to Central Garden and Pet, but it's top of my mind, and I want to make sure I got it in because it was actually one of the questions I really had when looking to this. The company historically has spent about 2% of revenue on advertising. And they said, hey, maybe that was too low. We're going to take it up to 2.5% over time. And I didn't comp it to anything or anything. So maybe I'm just being a fool throwing a question out. But it did strike me, both home and garden and pets, those are very much brand, like you build that brand loyalty. And I did think like 2.5% on advertising, even that does seem small for a kind of consumer brand. Are they under investing in advertising, or am I kind of missing something on that side?
No, it's a great question. And it's one that I still have. Historically, they spend around 1%. Now they're moving it closer to 2%. I think normal consumer packaging brands may spend more than double of that. So I think maybe it just comes down to the spaces they play and the recognition of the brands they have, and whether, I don't see insecticide commercials. I mean, I used to see Roundup commercials, but some of these products just maybe generically don't require as much advertising. Similarly with Global Pet, I think you made a really good point that you want to give your pet consistent food or treats or things just because the pet, it'll be agreeable with the pet. So I haven't been able to speak with the company. I did reach out. That would have been one of the questions I wanted to focus on.
Yeah, no, it's just because, look, advertising is an expense. It's a piece of your line, but it just did strike me as these are pretty, once you pretty sticky, you get a pretty nice multiple. It just seemed low just in a vacuum. You've mentioned Central Garden and Pet a few times, and I have not looked at them in a while. I do think I remember that this is it's got a super voting structure, but I think I remember that there was someone from Liberty Media on the board, which is why I looked at it. Look, that company trades, it's in the name, right? Central Garden and Pet. That's going to be a pretty nice comp for the pets and the garden market for SPB. That company trades for, I'm just looking at Bloomberg, 10 times EBITDA. You mentioned the unlevered free cash flow number, but when I look at that trading at 10 times EBITDA, and I look at Spectrum Brands trading at, if HHI goes through, maybe 9 times trailing EBITDA. We've talked about how the trailing EBITDA has been impacted by inflation, but Central Garden should be running through some of the same issues. Like, I don't see that big a multiple discrepancy. So two questions for you here. Is Spectrum Brands remaining businesses, are these just better business than Central Garden? Do you think Central Garden is getting maybe a control multiple discount, and long term, it sounds like you think these two businesses might kind of be meant for each other?
Yeah. So look, I'm not an expert on Central Garden and Pet, but I certainly studied it in the context of Spectrum. Look, I think Central Garden and Pet, let's just pick their pet business first. They do focus on quote unquote a little more durable stuff like dog toys, their nylon bone brand. They also do dog pads. They do warming things for pets. And they also focus a little bit more on bird seed. I don't have their breakdown between aquatics and companion pet, but I'm sure it's similar to Spectrum. But I think their margins are lower in part because they do private label. But I think even before that, if you look at some earlier reports, I think you would see that. So I think on the pet side, I think Spectrum would definitely skew to have more consumables, and I think they have more recognizable brands. In terms of the garden side, look, I think Central Garden and Pet has some exposure to controls, albeit, it's, I think, more of a distant third versus SC Johnson and Spectrum. But they also do have a grass seed business, a fertilizer business. So it's actually a complementary business to what Spectrum has. And so I do think there's a control premium discount. I think, the company does have some leverage, but again, it trades at 10 times EBITDA. I do think, that is, if you slapped on that multiple to the remaining businesses of Spectrum and assume that they got the base case of $3 billion really, or $3.1 billion of proceeds from HHI, the stock would be worth $125 or something.
Yep. And as you said, Central Garden, probably a worse business. Like, just, you mentioned the private label that they do, but also if you're selling dog toys, those are generally one-time purchases. It depends how quickly your dog's going through the chewing bit and stuff, but those are one-time purchases that are going to have a lot less loyalty than something like dog treats, dog food, all that type of stuff, which is more heavily where SPB's businesses are. So, you said it trades for 10 times EBITDA, slap that on to SPB and you get a really nice number, but then you adjust for the control premium, the voting control discount that Central Garden would get, plus the fact that it seems like SPB's businesses are probably a little bit better. So you could say CNET's 10 is SPB's 12, which, that gets you a nice place. Spectrum Brands, their pet business, I've got Penny. I'm a dog lover, obviously, so I tend to focus on the Nature's Garden, all that type of stuff. But if I remember correctly, their aquatics business, which I don't think about because I don't think about fish a lot, but they've got Glowfish, Tetra, Marine Land. I mean, I think these are like the best aquatic businesses out there. Am I misremembering that?
No, Tetra is a leader in food. They're a leader in, I think, tank-related equipment, filtration. That used to be a bigger part of their business. And again, fish tanks are not is a much more durable good. Glowfish, I believe, is actually the ability to create fish that glow in the dark, which is pretty cool. But yes, I think they are really the leader in the aquatic space, which is really not really a growth business. I think we highlight that the number of pet fish has not grown over a pretty long period of time when compared to other pets. But yes, I would say it's bigger. It's a niche business, but they are the player.
And I think there's a little bit of, that was going to be one of my questions. I do think fish at best have like kind of stalled out, and at worst they're probably in decline because people just, they've got a lot of Fortnite to watch. There's no time to take care of a fish, but that is a pretty stable business. And I do think there's engineering components to it, right? Like if you go to a family and you say, hey, you're getting a fish for your kid, Do you want the name brand filtration system, or do you want the knockoff? Generally knockoffs are just as good as the name brands, but this is keeping the fish alive, right? Like, you might have to explain to your kid why you're flushing the fish down the toilet 2 weeks earlier if you get the knockoff. Like, that's no bueno, man. That's no bueno. So I do think there's engineering components, obviously distribution, all that, but I would not be surprised if these are pretty nice, pretty moody businesses. And as we've talked about, the multiple, they're not really getting credit for it. I think we've walked through the majority of my questions. Oh, last question. We got to talk capital allocation. Everyone who listens to this podcast knows my second question is generally like, why isn't the company buying back stock if they're so cheap? I think the company is buying back stock here, but I've been really impressed by how they've talked about capital allocation. So I'll stop ranting. I'll let you talk about capital allocation, M&A here, buybacks, all that type of stuff.
I just want to go back to Central Garden and Pet. I do think one of the questions you asked is, why would it be a good fit for Spectrum? I do think they do complement each other in the sense that the fertilizer part, the wild bird seed for Central Garden and Pet in their garden business. And again, on the dog side, we've highlighted certain complementary businesses. It's worth noting that David Mora, as part of HRG, did bid for Central Garden and Pet back in 2014. And so once interested, always interested. I think that is a real consideration. Plus, this chairman with the majority control is 81. So I think those are two additional pieces I'd highlight. The question of capital allocation. Look, I remember when you asked me about Brunswick, you were surprised by the pathetic insider ownership. No offense to Brunswick. Here, look, they bought back a lot of stock. They bought back a lot of stock after they sold Energizer and Global Auto Care. They've been more cautious in terms of buying back stock now, to a lesser degree, only because really they know that the downside here is they get the $350 million break fee, and they probably figure, let's get closer to the deal and let's have more certainty, and then we'll make it happen. So you can read all the quotes in the write-up and you'll see how aggressive they feel about it. Insider ownership, David Mora owns a lot of stock. I'd say almost 1.5% of the company on a beneficial basis. So a lot of his wealth is here. I don't know what other outside interests he has, but he has also bought stock and he's acquired stock through grants. So capital allocation, I think, is one of the most interesting aspects here. I say that they can buy anywhere from 700 million to 1.2 billion of worth of stock. In a bull case, obviously, they're buying stock at a higher price. In a bear case, they're buying stock at a much lower price, or maybe not too far from where it is today. And that's really what juices the per share earnings and free cash. And really, it will be a big shift. You go from, today 4 times levered to going net cash, which is unheard of in this space from what I can tell. Yeah. And then you're going to back up the truck for buying stock because, frankly, M&A in the pet and home and garden space is just really expensive.
That's one of the things that's so interesting here. Like, look, you've said through this podcast, you've been consistent in saying your base case is that HHI doesn't go through. It's worth $3.1 billion in some form or fashion, right? That's been your base case. But it's so funny to say that. I hear you're being conservative and everything, but like the base case should probably be they have a signed contract to get $3.5 billion in proceeds. Once they do that, as you said, like they have net cash on the balance sheet, which you do not find stable consumer brands with net cash on the balance sheet for very good reasons. They are stable consumer brands. Private equity would love to lever them up and, just run that thing. And I think they said, hey, our long-term target, it's 2 or 2.5 times net leverage. I think you can get there real quickly by taking $400 million of EBITDA, 300 million, whatever number you want to say, bring it to 600 times 2. That buys you 20% of the company, right? So you could just do a big tender right off the bat. You could just get real aggressive with an ASR, but that the math works and it creates a really interesting out year free cash flow per share number. As you said, if the deal goes through and they buy back 10, 15, 20% of shares at anywhere close to these prices. All right. I think we've hit all my questions, but I always want to turn it over to you. Anything we didn't hit that you wish we had hit? Anything that we kind of glanced over that you think we should have hit a little harder?
I think we covered a lot of things. I would say tactically, if someone is looking to trade this stock, look, if the deal doesn't go through, the stock will go down before it goes up. So, that's just how, trading happens, and obviously they have to secure another buyer. If it's a PE buyer, there shouldn't really be any time issues there in terms of how long that will take. But that's just, I want to just caveat everything with that view.
Everything's risk reward, right? But yes, if this deal doesn't go, if the HHI deal doesn't go through, the stock probably goes down the next day. But that's because there was an event path, 50% chance that the deal went through, 50% chance that the deal didn't go through. But the fact is, like, as you've walked through, even if the deal doesn't go through, slap a conservative multiple on HHI, they get the $350 million in break proceeds, right? Like, the stock still looks very cheap. And yeah, it sucks they can't buy back 20% of shares tomorrow, but like, that doesn't change that the math still works, even if HHI is worth $2.5 billion, not the $4 billion they were going to sell it for or something.
Yeah, I think the only things I would highlight, we got some questions on Twitter. I think I tried to address them as quickly as I could. Look, in terms of pricing power, these guys at the beginning of the year were anticipating taking down 70 to 80% of inflation. Inflation has stepped up from their previous guidance because of ocean freight. But that said, in their recent call, they said they've gotten 98% of their price increases approved by their channel partners. And so I think that speaks to their ability to get some price on their products. As you said, Andrew, they've claimed that they've replaced $400 million of inflation over the past 18 months, roughly, with price. So, look, I don't know if 2023 itself is set up for an amazing year. In terms of 2022 rather, just as you said, Andrew, a lot of inflation. In terms of global pet, it's not a seasonal business, but there was a lot of issues shipping from Vietnam and Cambodia, their rawhides. And so now they feel they have the right product. They're good to go. TriStar will benefit HPC, as will pricing in the back half of the year. And Home and Garden, we'll see where weather shakes out. But obviously this quarter is the big moneymaker. Q1 is their least interesting quarter. So if someone really wants to trade earnings, I think you'll see in recent analyst reports that people are down, are kind of taking down numbers for this quarter, just given the destock we've talked about, just given the questions about weather. I think that's helpful. Obviously, the stock may trade a little down on that, but I think it's helpful for expectations going into the call, where some people think that they may take down guidance. I don't have a strong view on that. But yeah, I think the management team has gotten a lot better with communication. I think they've executed well in their productivity program, which I can't say I'm an expert on, but anytime you're able to raise the net benefit from 100 to 200 million, I think you're doing something right. And I think everything they're saying makes a good deal of sense. And Randy Lewis, interesting guy, sounds like a real operator. David Mora, good portfolio manager. As we said, buying a business 7.5 times EBITDA, selling a business at now 14 times EBITDA. I think he's learned a few lessons. I don't know him personally, but I think he's doing the right things.
Not only did they buy the business, but they grew it a lot at 10 and sold 14, but they grew it a lot in the midterm, which, that's really where you get the true magic of, they bought it for a little over $1 billion and they're selling it for a little over $4 billion, right? That's where you get the true magic. No, look, all that makes sense. I mean, the environment's scary, but the thing to me with both BC and this, obviously different drivers, different, all that. But to me, it's, you found companies that, hey, right now people are worried about cycle. People are worried about inflation, but these are fundamentally good businesses with fundamentally some type of moat. Like, yes, they're not Apple, but they have moats. They should have competitive advantages. And if you're willing to look past the next 2 to 3 weeks, 2 to 3 months, if you're willing to look 2 years out to when the cycle fully normalizes, like you're buying for BC, you're buying it for 6 or 7 times EPS. For this, you're buying it for 7 times EBITDA, which good consumer brands do not go for 7 times EBITDA. And with both of them, you've got hopefully aligned management teams who have shown that they will buy back a lot of stock when companies are cheap. So I don't know if you want to add anything to that, if you agree, if I put the words in your mouth.
Yeah. I think insider ownership is a little better here. I do think SPB management can sometimes be a little promotional, but I do think it often lines up with the activities they want to do. Just 2 other things I want to note. I was just doing this today. If you take HPC, you add up how much they paid for TriStar, how much they paid for Russell Hobbs, that's about $1 billion. And then you're getting Remington, which I say is a $400 to $500 million business. Assuming it has average margins, you're getting a $40 million EBITDA business, quote unquote, for free. If you assume that what they paid for it was worth today, maybe you argue Russell Hobbs is worth less because of margins, but that's just another way to kind of back into, what is it, 800, $1 billion worth for HPC. Yes, I think we covered a lot of bases.
Perfect. Well, PJ, look, I'll include a link. PJ, I love what he does, where he does a full write-up and then he publishes a one-pager. So if you just want the summary, you can go check the one-pager out. If you want the full write-up, you can check that out. I'll include links to both of them in the show notes. And then you've obviously got the full podcast to discuss all the different issues. But PJ, thanks so much for coming on, and looking forward to having you on for Pod 3, hopefully in the not too distant future. Good.
All right. Hey, yeah, Andrew, one last thing. I know I mentioned quarterly earnings. I think the reason to be in the stock now, though, is I do believe whether it's Assa Abloy's call on a week from this past Tuesday, or in Spectrum's call, there will be some updates. Whether it's providing HPC's carve-out financials, which I think is a precedent to them being able to sell it or spin it, or whether it's an update on HHI, I think that's where investors are going to be focused on.
Perfect. All right. Well, hey, thanks again, PJ, and we'll chat soon.
Take care.